Hello, everyone, and welcome back to the J22 Report. I'm your host, Johnnie Market. You all know that drill. Smash that like button, subscribe if you haven't, and just remember the disclaimer nothing should be construed as financial investment advice. These are just my opinions, thoughts on the market. And I wanted to do some interesting, I was getting into some interesting charts today. And I was looking at for one for silver. I'm not a technical analyst. I just think this is pertinent and valuable information. So let's get into it. I'm going to share my screen real quick, and we'll have more stuff doing, but we'll get into this. This is silver, but I want to get into, let's see. First, I want to get into the stock market. And I was looking at the Spider ETF. And gosh. All right, good. So if you actually look at this, this is like a long-term chart, 50-day moving average. So if you look at it 95, even during this bull market, it wasn't really significantly higher than it was today. And what happened was it came up, started moving. And then around 2000, it came down, tested, broke below. That was the signal of a bear market, which it came down, it was below. What's ironic was the market was sort of, and then in 2005, it sort of broke out. 2008, I remember the Dow made a new high. And then came out way above the 50-day moving average, and then there was the crash. And for the longest time, up until, let me see, 2010, that's when it sort of broke out a new bull market. But if you look at it, this is around, wish they had 2020. It sort of was up a little bit. It was never up that much all through. Let me see. Gosh, I wish they would have the years. They were better with the years. Yeah, 2011, 14, 15, it was choppy and sideways, but it was still above its 50-day moving average. And then in 2018, I remember that was during the reverse repo. It went and touched the 50-day moving average. And then in 2019, they started lowering rates. It came up. And then 2020, that was the COVID crash, and it literally touched based on what I'm saying, the 50-day moving average. And of course, they did QE away all the way up, and then it went really out of hand. If like you look at it here, the moving average was around 331, and here it's around 467. And then that was the beginning. This was around, gosh, I wish this would be, let me just find the year, 2021. And what happened? That was the beginning of the bear market in 2022 for the stock. And it basically went to just touch the moving average. It didn't break it, but it went to touch the moving average. And then it began another one, basically tested around in 2023, but then that was like sort of the AI bubble. What was that one? Liberation Day comes down. But if you actually look at it, right now, this is around 687, or I forget what I used. I used, oh my gosh, 634. Because right now it's at 634. And this is around 496. So the difference was I did this before. This is my phone/calculator, but I used 133.55. And that was the difference between the moving average. If it does what it did in 2022, that will be a 21%, which I think it was. Because if you look at it, this is way overextended, way more than 2021. 2021 was really extended, and that began the bear market. 2022, this is way more overextended than it is here. So this would be a 21% correction. And so a 21% correction based on 6368.85. We'll just do 21%. 6368.85. So 1337.45. So what I got was, you're just going to take my word for it, 1337.48. Yeah, see, it's blurry, so I was going to show you. 0.45. So the S&P, 1337.45. So if you actually look, I'm just looking at the S&P right here. I'm just gonna round it up. It's 0.45. So that means the S&P probably is going to go back down to 5,000. That's what I have, roughly around, it was like 5031. I'm being generous here. I think over the long term, we're getting to a bear market where it's going to go sort of back to the COVID lows. But I would say over the next couple of years, just being generous, if it just goes to touch the moving day average, the S&P is probably going back down to 5,000. So that's, 20% correction. So I do think the time, if you are an aggressive bull market and think stocks are always a great thing, I think 5,000 S&P might be a good time to buy some. You don't have to buy all that much, but I'm probably not going to buy until the banking crisis is over, honestly. But I know that I'll be in Poland in a year or so. But yeah, so that's just one to say, just even being generous. This is, I think, the best case scenario for the market is it's probably going to go back down to 5,000. Because like, even if you look at just looking at this, generally it never trades this high. And the moving average keeps going up. So you can argue that the moving average kept going up, so it went to touch. So it was actually higher, but it wasn't all that much higher. Like if you look at it here, the moving average was 328, and that was like 360. So I would say a 5,000 S&P, and this is the Spiders ETF. So I just thought that was interesting. Next chart I'm gonna go to is silver, and if you look at it, silver. If you look at 2010, it didn't really go. I tried all. This is the worst chart because it doesn't go back at all to all. So, but it was from the last bull market. But if you look at it, it got way ahead of it, and then it broke, went below, and then 20. I think this is a good indicator because 2020 is when the bull market sort of started again, and that was the COVID where it went to $27. It was around $12 in 2019, but then they started lowering interest rates, and then COVID stimulus, and then it came back down, sort of went below the moving average, and sort of based for the next couple of years. And then it broke out around 2024 February. It broke out, got to 30, consolidated a little bit, and then I don't know the exact, but let me see. Around May of 2025, that's when it really broke out. That's when it really broke out. And so I think this 29, I remember the last thing is I did the math that if it falls similar to the way it fell in this 2011 top around 48, this would be the absolute bottom, $29. Now, I think anything below 60 will be a buy. But the only thing about physical, I was talking to this to my friend Rahul. He doesn't come on the show anymore, not because I don't want him to, but he's a licensed broker and he's worried. He knows he can come on whenever he wants, so it's just whenever he decides he wants to start coming on. He's just only does sports card. He doesn't do finance anymore. Just remember the disclaimer also, this isn't financial investment advice, just my thoughts. So I think anything below 60, but the only thing is the premiums are just way out of whack. And so I personally think 60, around 60, that's when you should, like, this is what I'm going to do. I was just thinking about it. I'm probably going to start getting into royalty and streaming. It's like maybe Silver Crown royalties or Wheaton precious metals or maybe stuff like Pan American silver. I might layer into, and around below 50, I'll probably, even if the premiums are out of whack, remember the COVID ones. If you were willing to wait, Silver Eagles were around 38 bucks. If you waited and then sold, and I think so, but around, I'm not really going to start buying any physical until it's around low 50s or early 40s, because even if the premiums are out of whack, I personally think if you wait, you're going to make way more. And it's just, but 29, I think that would probably be the absolute bottom. It would be like if you go to, let's see, 16. So it got to 19 around 2014. 2015 got to $15. Then it went to 19 again. So let's say just around 15. That was in 2015. Then it went down again. Let's see. 2018, 19. I think at most, if it gets below 50, it could stay there for 2 or 3 years. I don't think the bear market will be as long as this one, so maybe 1 or 2. So I don't think you need to be, if there's high premiums, I don't think, in my opinion, not advice, I don't think you have to rush to buy immediately. You can wait till the premiums sort of mellow, mellow out. So, but the thing is, 2015 through 2019, that was the time to buy because they had semi-normal premiums, meaning they were. I remember where I used to sell, Silver Eagles had a $4 over ounce premium, and where I sold was actually expensive compared to everywhere else. And now that's like the norm. I remember the premiums used to be so low. So, but 29, I think this is possible because if you look at the last, it 26, but that was from 48 was the moving average. But it's sort of, if you look at it, this is way longer than here. So I think 29, I think the moving average when it comes out, I think this is a good thing because if it breaks below this, if you look at this, this was 2013, it broke below this. It stuck below this for 2 or 3 years. And then it just based around in 2020. So when it breaks, if it does break below this, so I'm going to start looking at this because I think it's a very good. Let's just see what GLD real quick. Do chart. I'm just going to do all for now just because I remember the market by heart. I remember the gold and silver markets by heart. I can, everything that happened dating back to when we left the gold standard, I can tell you without looking at any book or notes. So let's see. I'm going to try to do all. If you actually look at gold going back to 2010, this is the last part, and then 2013, that's when it broke, and 2000. So when it breaks and it starts testing this, you know it's going to break out. So one new tool of informational research. This is just, you can, and you don't have to pay for this. You can just go to Yahoo Finance, go to GLD, look at the shares. 2010, it goes up, and then you can tell this is, look at this is around 2020. So I would tell you to stop, and then literally tested this in 2022. That was the bottom, 2023, and then that's when, and sort of like 2010. So I don't know if we'll have a bear market quite like that, but the charts might say this. But 237. Now this is GLD. Let's see if we can actually do gold spot price. I'm gonna go. Of course, I used to just scroll over. Let's see if we can do gold. Because yeah, that was 29 in the GLD, which is like really 39 in which is really like 39 in regular price for whatever reason. Let's do indicators. Yeah, so if you look at, this is a 1 day, so I just do all so I can know, like I go for the long term. So yeah, if you look at it, 2005, that's when the bull market began. 2011, and then 2000, when it breaks below, if it starts coasting like this, 2020, that's when you know. And it came to test it around 1600. That's when it really hit this moving average, and then it really went up again. So the moving average is 2,400. So I think anywhere around 3,000. I think anywhere around below 4,000 will be a buy. But I would say these are like royalty and streaming companies, good companies, maybe Anglo Eagle. And then below that, you can start layering into physical and miners and whatnot. Because when the junior miners and everything fall, they fall badly. But based on, if you look at this, 1,200, I think I don't think we'll see sub 2,000 again. I really don't. I don't think we'll see sub 2,000, but this is 24. And we may see sub 3,000, but anyway, that's all. This moving average does say a lot, but right now it's up. And I think in terms of buying physical, I think this is a good indicator because physical gold doesn't have the outrageous premiums. Let me take a look. JM Bullion. I'm gonna go to my friends, Monument Metals. I'll go to they always have great prices. Gold. They're always. I'm gonna do. I remember $50 or $60 above spot. Let's just do Canadian gold maples. They're not an expensive bullion product. I'm gonna do random year. 4580. 4580. What's gold spot price? So yeah, 4580, 4507. That's not that bad of a premium. So I think early 4,000s might be a good time. Might buy a gold coin if it goes down some more. I have to figure that out. So anyway, we'll just leave that there. But yeah, I think this 50-day moving average is a good way to when it goes around there. So anyway, My opinion on gold is I still think there's one more upswing and then there's going to be a multi-year bear market. So doesn't mean it's not, I remember, I'll just say this. The old person in my company, you can say the same thing. When gold was around 2008, yeah, there's a one more upswing, then there's a long-term bear market. But before that upswing, he said he sent out an email, buy gold at 800 because you're never going to get this chance again. It was one of the best calls I've ever heard. And even though there was another bear market, even though there was 3 years from now, there was a bear market looming and a multi-year bear market looming, doesn't mean it was a bad buy there. That one more upswing, it wasn't going to be fully retraced. It was mostly retraced, but you didn't have a chance to buy gold at 800 again. So whoever bought it, they're permanently in profit unless something drastically happens. But anyway, this Iran war, talk about oil. This is why I'm still this isn't why I was bullish on oil. I thought it was cheap. I thought it was inflation. I think this just exacerbated and gave the market an excuse to get oil more. Obviously, we can't win this. This is the catalyst for the bear market, and that's what I think it is. Is I think the bull market in stocks that began in '09 is basically over, in my opinion. Not financial investment advice, but I think it's basically over. And I my target is 2000, 3 to 2000. Maybe if it goes below 4,000. I said over the next couple of years, a 20-year bear market. Just if it did what it did in 2022. If we have a repeat of that, that's the best case scenario. So anyway, but oil, I think, is going to 120 or 150. I'm going to probably put a 20-day, 20% stop loss once I get there because I just don't know. Oil is the most crazy market, and I've gotten in. And if you actually look at it, let's look at Suncor. I'm just going to do, I was bullish on Canadian stocks. And if you look at it, this is one day, it's up. If you look at it on 5 days, it's up 7%. And 1 month, 17. And I remember the oil stocks didn't follow initially. And that's because the market was pricing in a quick strike. As this war goes on, Canadian Natural Resources is another one. Just disclaimer, I own it, not buy or sell. But if you actually look at it, these stocks, Canadian 1 day, 5 day, it's up 4, 1 month, 14, 6 month. They're now starting to price in a longer conflict, which I wish it's over quickly, but I don't know if it will be. I hope it ends soon, but oil's driving up yields and it's driving the easy money out of stocks. If you look at Dow Jones below 793, almost an 800 decline, 2% over a 5 day, 1 month over 7.6%. On a 6 months, it's down 2.4. Year to date, down 6%. Still up over a year basis, but look at the trend, it's going down. So I think this bear market's over. Doesn't mean I'm right, but I mean, I think this bull market in US stocks is over. What is EEM? I think is emerging markets. Let's take a look at that. That was down. I think these will be in a short term, meaning multi-year bear market. If you look at 1 month, 6 months, it's up 3%. It's outperforming the US. Year to date, even though it's flat, than 1 year. But I think this is a short term. I think oil prices 150 and whatever is going to destroy a lot of them. So these are other things. These are trends I keep following. This is why we'll be in a, I think, 10 to 20-year bear market, is that Americans are moving to these 10 countries in droves. And so here's what they say. Mexico is number one. Portugal, which, yeah, I've heard a lot of people love Portugal. Spain, there's one, the Netherlands, which, yeah, Germany, Singapore, Costa Rica, which Panama, Italy, and then France. And I think this is a trend that's going to happen over the next 10 to 20 years because life in overseas is better. It's going to be better for a while. Maybe in the 2050s, it will be better, but and then Social Security. This I just found this interesting. Trust funds reserves are projected to be depleted by 2020, 2032, and 2034. I remember it was like 40 years from now, 50 years from now. Now and then look at this. This would necessitate automatic benefit cuts of 20 to 25%. So yeah, I mean, everyone thought this would be after the boomers, but you look at it, the boomers are the ones that might be getting their benefits cut and everything. So, uh, if you look at this, things for the U.S. economy are not looking good. I think the stock market, bull market that began in '09, I think it ended last year. That's what it looks like. And I think everyone talks about, oh, look at these fundamentals. What they thought war would be bullish, and look at it, goes down, and they do these mental gymnastics. The truth is, no matter what market, when stock markets decline, it doesn't matter if it's gold, oil, or whatever, generally speaking, there's always a period of force majeure where they have to cover what's profitable to cover losses. Because in the actual economy, people have debts. They have, like, for example, I lost my job and I lost my job and I had a bunch of mining stocks. I sold them. Now I'm not the market. I don't move markets with my buy and sells, but I sold my stocks to pay off my car loans because I had no idea when my next paycheck was going to be, and I didn't want that monthly payment. So now I own my car outright. I need to get the title. The state I used to live in has it. So, but anyway, remember, nothing should be construed as financial investment advice. Just my opinions, thoughts on the markets. I will see you next video.